plus years where monetary dominance was in play, basically the bank lending decisions and by extension the central bank tailoring its policy to either encourage more lending or pull back lending. That was monetary dominance. Now we're in more of a fiscal dominance environment, meaning the size and the direction of the deficits are generally speaking a larger variable than the central bank and even kind of the broader banking system. Really, the only thing that's changed since then is obviously tariffs have heated up, recently. And so that's a slight break on the fiscal deficits because you're bringing in more revenue so far, mostly from the American public. And so that kind of offsets the deficits, but that's still fairly small in the grand scheme of things. We are still running above baseline deficits as a percentage of GDP. In addition, we have more information from the Fed, which is that, it looks like they're going to be a little bit more dovish going forward. So while variables have changed, we're still largely in play in terms of fiscal dominance. So it's more so a US phenomenon than a global phenomenon, but on a country by country basis, it's certainly relevant. I think, there's a cycle that countries tend to go through. The US currently is running larger deficits as a share of GDP than most European nations. It's part of the structure of the euro itself that makes that a little bit more difficult to run larger sustained deficits. But they all have kind of similar dynamics, which is older demographics. They fuel some of the deficit spending because you have that more top-heavy entitlement system. So whether it's China, whether it's Europe, whether it's the US, they all kind of are in that boat together. And it just so happens that because US healthcare is very expensive and the way we've kind of structured our entitlement spending, as well as generally speaking, a bigger share on defense as well, we're running hotter than the rest of those. But, things matter around the margins. So the fact that Europe's running hotter than is normal for Europe is still relevant from an investing standpoint. It's just in absolute sense, the US is really kind of fiscally the most dominant. On one hand, it tends to run hotter, which is to say that when you're running a larger deficit, all else being equal, that's somewhat of a stimulus, with the cost often being basically debasement or inflation, at least above target what it otherwise would be. And it also tends to be less cyclical because a lot of those deficits are not really tied to the business cycle per se. If anything, they increase during a recession. And so while it's still possible to have recessions and you still do have cycles, they tend to be somewhat muted. It's kind of like how if you look at equities, there are obviously certain equity sectors that are a lot more cyclical than others. Yeah. Whereas, some like defense or healthcare just tend to be on their own cycles compared to, these more business cycle ones. And what happens in fiscal dominance is kind of the broader economy tends to look more like those types of industries to some extent because the deficits are kind of always on compared to the more cyclical nature of bank lending. One way to kind of put it is that over the past 70 plus years, for the majority of the time, net new annual bank loans, and you can even add corporate bonds, so bank loans plus net new bonds issued, that was a larger sum than public deficits. Whereas only kind of in brief recessions do you see that the public deficit would be greater than that kind of private sector lending. Whereas now we generally see, even outside of recessions in recent years, the public deficit is larger than the sum of all new bank loans and corporate bond issuance in a typical year. It's not to say that there's other things that aren't relevant, but they're a smaller share of the pie than they used to be. Yeah, I think he took a slightly dovish take compared to what the market expected. And the market kind of pretty much priced that in as soon as he was speaking about it. And basically what we should expect is generally at least slightly lower interest rates. He made no commitment to the idea that he's going to keep doing it in his 2026, but he did heavily imply that we're at least getting one or two cuts perhaps upcoming. One of the challenges, this goes back to fiscal dominance, is, their interest rate tool is mostly around trying to get banks to either lend more or lend less. Because, historically speaking, during periods where inflation's hotter, there tends to be a lot of money creation from bank lending. So for example, in the 70s, when the baby boomers were entering their home buying years, that was kind of the peak period of US loan formation. There's a lot of loans being done and greater than average money supply growth and the inflation that came with it. Obviously, there are other factors like the oil shortages and things like that, where that money supply growth actually does translate into much higher prices because you don't necessarily have that productivity offset. But basically, that bank lending is a really big component of it. And so most of the tools are around that. The problem is that in this whole kind of COVID and post-COVID environment, because we're in fiscal dominance, the inflation we've seen has not been from excess bank lending. Bank lending rates are pretty muted, if anything. They're kind of historically normal and on the lower side. And so the Fed trying to keep rates high to slow down bank lending is kind of working around the problem. The actual core of what fueled all this was the deficits. Back in years ago, it was the stimulus, and now it's a less extreme but more sustained, just ongoing, fiscal spending, which tends to run things hot. The Fed kind of finds himself in a position where there's no right answer. If they cut rates, it doesn't look great because they're cutting rates into like all-time high stocks, gold, Bitcoin, low employment. It kind of looks dovish on that surface. On the other hand, the housing market is pretty much at a standstill. I think even with some cuts, it's not really going to change that. And bank lending is not the issue. So I can certainly see why they'd make a case for cutting. And fiscal dominance, it's more about the fiscal entity than what the central bank's going to do. So I'm still bullish on Bitcoin. Gold, I started warning about this spring because it got kind of heated. Fortunately, that's been more of a sideways consolidation than a correction. I mean, I think it's kind of burning off some of that heat, kind of like Bitcoin had to do a couple times this cycle. So I'm still long-term bullish on it, but it's still kind of working through that. I'm increasingly a little cautious on US equities at these levels, given the ongoing headwinds that are still there, including tariffs and things like that. I also think that rate cuts, while helpful, are probably not going to be as stimulative as people think, because without a kind of lower low in rates, especially longer term rates, I think any sort of like home refinancing cycle is going to be pretty muted this time compared to prior cycles. And so while it helps certain entities and individuals around the margins, I don't think that we'll have any sort of big gains from that rate cutting cycle. Where I tend to be more bullish is foreign equities. I still think they're very under-owned. In many cases, it's still fairly inexpensive, and the upcoming dovish cycle should be somewhat beneficial to them. So I tend to think there's a lot of kind of returns to be had over the next 3 to 5 years from more of that foreign sector. I would say at the macro level, although I would point out that I tend to be interested in some of the financials in those areas. So I've been interested in Latin American financials, for example, basically things on the more value side of that. And when people talk about like equity rotations, it's always hard. There's been this very like a long line of people calling for rotation over the past 5-10 years. We've had just kind of pretty miraculous outperformance of US equities compared to the foreign market. I think the kind of key thing to keep in mind is that anytime there's a rate cutting cycle, that's kind of like the shields down, where if rotations are going to happen, that's a really good catalyst for it to happen. It ended up not happening during the kind of the pre-COVID rate cutting cycle because we had all these other factors coming in at once. So it's not to say that a cutting cycle does cause a rotation, but when you already have basically all this global capital on one side of the boat stuffed into US markets, huge period of outperformance, and then you do get ongoing cutting cycles, that tends to be a useful catalyst. And really, since the Fed started cutting last year, at least a little bit, we have generally seen an uptick in performance of international markets. In many kind of areas, they've kind of at least stopped underperforming. They haven't had some sort of major positive rotation yet, but at least there is kind of a bottoming if you look at some of these ratio charts. And I think it's useful to keep an eye to see if that sustains. I expect that it will, but I'm kind of fully aware that this has been one of the hardest things to call, is any sort of change in leadership. So for like 5 years, I've been a pretty outspoken bond bear, but now that yields are higher, I'm less kind of bearish going forward, even though I'm not particularly much of a bull either. I think that we will get shorter on the front of the curve. I think the longer end of the curve is probably in a choppy sideways pattern. So it's a tradable asset, but it's not particularly compelling from like a longer term investing standpoint. You get potentially a lot of volatility without a ton of returns from it. I'm not that worried about credit quality overall. I think there's obviously some pockets that are concerning, but they tend to, it's a more slow unfolding default cycle, like for example, commercial real estate and so forth. Those tend to not be big enough to sink other parts of the economy. Unlike, for example, the subprime mortgage crisis was large enough, hit right at the core of residential housing. I think fortunately we're not in that situation. So these more kind of smaller pockets where, you might have a multi-$100 billion problem, which sounds like a big thing when you're talking in the size of the US market with well over like 100 trillion in assets out there. Those issues tend to be absorbable. So I mainly look out for big things that could affect macro. And I tend to think that at the current sizes, they're probably more contained to their areas. I think a still big question, I'm not the first one to raise this, is how long is this CapEx cycle in AI going to go? Basically the GPU cycle, the data centers and all that. Because if you look at the broad economy, most pockets are kind of stagnant, not doing amazing. And anything kind of tech or AI related is kind of lifting everyone up. And so as soon as that slows, that's another potential catalyst for global capital to want to get out. Then you have that inverse wealth effect potentially. And so whenever you have a very financialized economy where rising stock prices fuel consumption, and then that consumption fuels rising stock prices, the problem is that that virtuous cycle works well up on the rising side, but then it kind of surprises you with a vicious cycle on the other side. Well, I don't think we're there yet. It is something that I do monitor pretty closely, just because, again, there's all this capital already stuffed into US markets, and it doesn't take much to at least get a very kind of slight reversal.